Fantastic. Okay, well, good morning, everyone. Welcome to the Daily Energy Markets podcast. It's Thursday, April 27th. I'm delighted to be moderating this morning's discussion for a look around the energy markets. And I'm joined by Richard Radolia, CEO of Matrix Global Holdings, Ole Hansen, Head of Commodity Strategy at Saxo Bank. And for the first time this morning, we'd like to welcome Noor Azleen Ahmad, who's editor of crude oil at Argus Media based in Singapore. So welcome, everybody, and thanks for joining us.
Thank you.
Thank you.
To see you. I'd like to sort of go to you all with the first question of the day and get your take on that. Richard, perhaps I'll go to you first. We had just our survey question up there from yesterday, which we put to our audience, which was, does OPEC Plus have to consider already cutting again, as it did a month ago, announcing more cuts? We saw Brent dip below $80, which is sort of supposedly the magic number for OPEC Plus these days to protect. So what's your point of view on that? And has the market completely absorbed that cut already?
I think it's interesting. I sent a chart to Madeline, which maybe she can put up. I think that we want to look at this in really historical context, that the market is obviously signaling demand pressure, that this is an issue of demand, right? We saw after the SVB bank collapse what occurred. The market basically flushed out most of the length in the market. It took it down, I think, to the longest, to the least amount of longs on the derivative markets since 2016. So we saw a real kind of a liquidation, right? We saw what happened was people who were long got out. And I have a chart here, which I think is interesting, and I think it's an historical perspective. Look back to the far side here. I think this is very interesting. When you ask people, what is Saudi's production? What do they produce? Well, they produce about 10 million barrels a day. But if you look back historically, Saudis were the only really swing producer in the market. And when you go back to the first real price collapse of 1986, which was a price collapse from $31 down to $9, it was really a function of Saudis saying to their OPEC, and then there was just OPEC then, saying to their OPEC members, we are not going to be the swing producer anymore. And what Saudis did was they took their production from 10 million barrels down to 2.3 million barrels. They were the marginal producer. And basically what they did was at the end of 86, they said, we're not the swing producer anymore. We are going to increase production. And the market fell to $9.75. That was the low and proceeded to be the low for the next 20 years, if not until the recent collapse back in 2020. Saudis did it again in if you look at the red circle, they did it again in 2014. They said, you know what, enough of this. We are going to put pressure on, in this case, this was pressure on the US producers. We are going to put pressure on you, and we're going to see what are your true economics. And once again, they opened the floodgates and down the market came. Interestingly enough, and this kind of gets obscured from COVID, but if you remember, the first week of March was after 2016, and OPEC Plus was formed, and Russia became part of OPEC, as the case may be, of the producers of the world. They started to cheat, and OPEC was trying to get some control over the price, and they were concerned that the market was starting to weaken. And if you remember, in March of I think the first week of March, they said to the market, no more Russia. We're going to now open up our floodgates again. And the market literally fell. I think it fell $11 that day. I think it was. This was, remember, it all gets pushed together. This was March 3rd. March 17th is when Trump stopped all travel. But it was really 2 weeks before that, the market fell, I think, $11 overnight. So it went from $55 to $42 and right to $33. And that really was Saudis saying, enough. We're not going to take this anymore. Well, now go the other way. And just to the point of your question, was back 2 weeks ago or 3 weeks ago, they said, we see a problem in demand. We're going to adjust supply. And I think this goes to me, which is the most important thing that we've really seen in the last, I'll say 10 years. We have seen the acceleration of information, and the acceleration of information causes a major thing to happen. It causes the market to be able to understand demand in real time. And when you understand demand in real time, and you have all the information that's available, then you're able to adjust supply in real time. And I think that's what we're experiencing here. It's happened. It just happened. I think it's been happening. It happened in March of 2020. We have Kepler to look at. There's no more cheating anymore. You can follow every cargo in the world. And so I think what we're seeing now is OPEC plus Saudis. But I think now all the other members are part of the equation, that they understand that we're gonna start to act like the Federal Reserve. We want a price at a certain level, and we are going to keep it that way because you're telling us 10 years from now you don't want our barrel. So we're going to adjust the price now.
Yeah, and make the most of the next decade. Thanks, Richard, for that. Very nice sort of introductory, big picture view, historical and looking forward. Ole, let's talk a little bit about the price and stick with the sort of same theme and OPEC. Clearly, Saudis stepped in 2-3 weeks ago and said, we're going to cut, just going to counter the short sellers in the market, admittedly, more than anything else, perhaps at the moment. But, again, they are foreseeing that the demand picture, and it's now a demand thing, is not as strong as perhaps people thought it might be in the second half of the year. So where are you today in your forecast for how demand's looking, global demand, Chinese demand, and the price has dropped below 80? How long will OPEC wait until it cuts again?
Well, clearly demand is softening, and that was as Richard also said, the reason why they did make the cut back in April. But I think where they did a massive mistake was announcing the production cut over weekends, because what you did, you created a gap in the market, for a $4 or $5 gap. And having been in the market for many years, if there's one thing that market traders hate, that's gaps in the market. So the first thing they were thinking about is not what's going to happen to the upside, but how soon can we get that gap closed. So basically, they forced a lot of shorts out to take a massive loss. At the same time, they forced longs back into the market around the $85 level in Brent, $80 level in WTI. And as the short sellers started to look for that gap, they increasingly got out of pocket and then joined the selling. So basically, part of the selling we're seeing here is OPEC's own fault because of the gap that they created in the market, which is added selling not only from short sellers, but longs that they forced in and are now getting out. So I think with that in mind, the big question here in the short term is whether we are seeing fresh momentum selling, just like we saw when we broke 80 last time around, which triggered the production cut. So the next week, I would say, is going to be very important. Will the market stabilize here and return to around the 80 level? Then we probably won't see anything. But if we progressively weaken, continue to weaken, then that could be we could at least see some verbal intervention first. And I think we should just keep a close eye on the refinery margins, because again, we're not putting crude oil into our cars; we're putting gasoline and diesel. Yeah. And refinery margins has come down a lot, but also they seem to be plateauing here, both in Europe and in Asia, and that potentially could be a sign that some of the initial stress is starting to ease somewhat. So I'll be watching refinery margins closely for the direction here.
Okay, thanks much, Ole. Noor, welcome again. Sitting there in Asia, where you are today, you're our Asian barometer, if you like. Again, addressing this question of demand, and obviously that's having a huge, putting the technical short selling timing issue of OPEC and how it timed things. But let's look at the fundamentals and how is the demand picture looking for you in Asia and for the second half of the year now, including obviously China.
Okay, well, I think I agree with what Richard and Ole said about the demand. I mean, the hopes of the soft landing has basically now been squashed, right, with the recent bank sector stress. And the US economy may have a mild recession. That's what we think. I think the one thing about supply also is that the Russian supply has proven to be a lot more resilient than initially expected. I mean, earlier, the Argus consultants had assumed that the Russian production in 2023 could be about 2.5 million barrels per day lower than pre-war. That got revised down to 1.5 million barrels per day at the end of 2022. And the latest forecast by the Argus consulting team is that the Russian production would be just 600,000 barrels per day of lost production in 2023. So that, I think, has had a big impact on where the prices are going right now. In terms of the demand, I guess what we see is that China demand is forecast to increase by about 700,000 barrels per day this year. So that's 45% of the total increase in global demand. So I think there is some concern about the downgrade in Chinese demand. And even though from this side on the ground, we do see that there is recovery, but it is a slow recovery in China. It's going up slowly and it is not a surge. And again, as Ole said, the refining margins right now in Asia is a concern. The refiners, the traders, even the producers, the Middle East producers are watching very closely where the refining margins are right now. They haven't crashed, but they're slipping over the last in April compared to March. The cracks for jet gas, kerosene, for gas oil, naphtha, mogas to Dubai crude have been easing. And we are hearing some chatter in the market in Asia about refiners thinking or at least considering the prospect that they may have to reduce production, reduce refinery runs. So I think that's going to be, the demand is a big factor right now, even for the refiners.
Okay, thanks very much, Laura. And just before I go back to Richard, Ole, on the point of that in terms of the Russian production point, and now, forecasters are saying for this year, we've talked to people this week who are saying, we won't even get the 500 barrel a day cut that Russia has said it's going to do. We're not seeing evidence of it yet, Ole, in the market. I don't know if you'd agree with that, let us know. And that would be the maximum we might see for crude and products combined for Russia. What's your take at the moment, Ole, on what we're seeing in the market of Russian? And we've got a bulletin story today that says, product exports are rising out of Russia.
Indeed, and I think I can only just adhere to the data that we're seeing coming out, and looking at what could happen from here and going on and onwards. It could really only be any firming up on the price caps, because there's clear signs that oil is being sold above the price cap. That may not be necessary to focus on if we continue to drop at this rate, but when an oil price is cheaper than its competitor, or when you're selling oil at a cheaper price than your competitors, then obviously it will always find a home. That's how the oil market works. There's always agents who will be prepared to take the risk, and that basically means that whatever is cheap will find its way to the market. And I think we've seen a clear sign of that. And any further reduction really has come from official Russian stance, and yes, you said they announced a 500,000 barrel cut, but so far we are still not really seeing that playing out in full.
Yeah, and I suppose it may be impacted by demand as well, what the pull on those products are. Richard, back to you. I want to refer to another headline in our bulletin today, which is US oil patch is poised for buyout wave as US drillers seek new land. Would you agree that we're going to see a little bit of impetus come back into the US market, if you like, in terms of supply and new investment and new discovery? And if so, what's spurring that?
I think it's the cheapest, safest barrel to find, right? Exxon is obviously the one that's on everyone's tip of everyone's tongue. If they're going to look to buy Pioneer or someone like that, they'll expand the pipeline that they have to make it even bigger, and they'll run it into their two huge Houston refineries. The U.S. is the biggest exporter of products in the world, and this is just another way for them to make it easier for them to get the crude that they need. There's always this imbalance on as far as quality is concerned between sweet and sour and heavy and light, but that can be traded away in many cases. But I think that's exactly right. There's it's interesting. Two things were said. There was one of the people that is on this podcast periodically told me something which I didn't know, which was in Russia. The Chinese make every valve that's needed, right? Every pump that's needed. It's all being made now. I was under the impression a couple of years ago that you know what, if you don't have a Halliburton and Schlumberger there to help you increase your production, you're going to falter. And obviously that was wrong, right? I thought there was going to be no invasion of Ukraine either. So I've been wrong on many, many things. But in the case of Russia, that's an issue. And that, maybe that's an issue that we saw back in 2020 is, there's something for us to ponder. Is that a sticking point? Does Russia take advantage of a situation down the road where they don't cut if there needs to be further cuts? But as it relates to the U.S. oil patch, the money is flowing into it. If it's flowing anywhere, it's flowing into that area, but it's really flowing into the coffers of these large oil companies who are going to consolidate. And I think that's really what we're going to see. We've already seen Occidental and Chevron. We've seen that Exxon, Pioneer. There's hundreds of small producers, so the consolidation will continue. There is a analysis group in the U.S. called RVN, which is an interesting kind of daily message, and they're the ones who probably have the highest production forecast that I've seen to date. They have it production in the U.S. I think in 2026 upwards of 14 million barrels, 14 to 14.5. So that's the highest number I think I've seen anywhere. Everyone else we kind of go along at about 12.2, 12.3, 12.4, something like that. So money will flow. But the point you make is a very good one, I think, and it's one of the three major factors. And I've said this, and I'll say it again and again. To me, the issue is not now. The issue is not this 1 year or 2 year. We know we live in our bubbles of short periods of time. The issues really is 2, 3, 4, 5 years down the road. Is we're talking about incremental increases in demand, and the question is the governments of the world. There's three things going on. One is capital is not really flowing into the upstream sector around the world. Maybe in the US, there's some issues what we're starting to see, but everywhere else, it's not really flowing into the upstream sector. Two is governmental policies are forcing consumers to move away from hydrocarbons. Is that going to work? They're pushing it that way. Is that going to be the case? And I think the third one is we talk about information technology and giving this ability to adjust in real time. To me, is what happens when when supply gets up to 104, 106, 108 million barrels. Will we have the barrel? We're heading out somewhere around 2025 to 2028. This crossing over supply demand between peak oil, peak supply. Where are we going to be? Those are the real questions to look at.
Okay, thanks, Richard. Yeah, and I mean, that sort of peak has probably dissipated a bit for this year, at least, but. And that sort of panic of that we are going to be very short in supply, but yes, in 5 years' time, maybe. Noor, just to go to you a bit talk about gas and Asia. Again, last year, we didn't have a huge pull-in from China. So gas prices, although they peaked last year, but that was on the back of the Ukraine war reaction. Then Europe managed okay, et cetera, et cetera. But this year, what's the feeling in Asia of being able to secure the gas that it needs if that demand does come back a little bit more in China? Gas from the US, LNG, gas from elsewhere. Is that factoring into thinking at all and planning?
Okay, so gas is not actually my area, my expertise, but I think that one thing we have to keep in mind as well is that on the areas where the consumers, like the Japanese, they have continued to invest in Russia in terms of the LNG. Like, for example, the Sakhalin LNG project, where some of the Western companies have pulled out. The Japanese refiners, the Japanese companies have continued to stay in there because of the security of supply to get the LNG cargoes. So to some extent, I guess supplies in the short term may not be really a huge concern, because I think they sort of like forecasted and they did realize that it was probably not a good idea to just rely on all the non-Russian. So I think that's what I can say. But I think that there's right now in the short term, it seems as if the fears of a supply tightness, even on gas, hasn't really come in. But it'd be hard to say where we go in 2024.
Yeah, of course.
Yeah.
And Europe is feeling a little bit more complacent these days. But then again, took a lot of measures and the prices are pretty low right now. So that supposedly is just going to spur demand again and uptake of that. Ole, let's go back to you. And I'm getting a few comments here on the OPEC plus cuts, and yesterday, as a survey question, had 50% of our audience, almost 52%, agreeing that actually OPEC Plus is going to be announcing more cuts ahead of the second half, which is now basically. I mean, even the May cuts aren't meant to start taking impact really until the second half. So do you think they will preempt that with sort of the talk of recession now dominating demand, if you like, demand story? Do you think would you agree with that 52%, Ole, that they could come in and announce more cuts?
Well, I think the result being a 50-50 just highlights the uncertainty in the market. But the small overweight towards a cut, yes, I believe it's possible if we do break well below 80 once again, starts threatening the $70 level, then that they may be triggering some action. But we also have to remember that it will be, that burden will have to be carried by fewer and fewer producers. Several are not prepared, are still actually increasing production. Nigeria has had a recovery recently, and that's going to make it tricky to actually get the numbers, get the cut through to that they should be decided upon. So I think they'll probably be a little bit hesitant with with that in mind, and also just considering that the bulk of the demand increase that has been priced in for this year is still backloaded into the second half, and I think at this point in time, perhaps they're not completely prepared to give up on that expected increase in demand. So I understand why it's a 50-50 answer, because it really is a tough one.
But what about OPEC's stance? I mean, if they are going to be so defensive of that $80, are they ignoring the fact that, the rest of the world is trying to deal with inflation? They're sort of countering the Fed policy, ECB policy, etc., which is trying to sort of keep things under control. Do you think they should be adjusting their thinking to 60 to 70 really is the price which the world is going to be able to continue buying oil at the end of the day, when we're looking at these even mild recessions?
Well, as long as we have global growth this year still in the plus 2% territory, obviously led by growth in Asia, then I don't think they should be too concerned. It's more a question if we start to see a broad weakness, then obviously 80 is potentially going to be difficult to be justified. But as Richard also said early on, they are looking for the optimal price over the next decade for their oil, and having achieved the ability to become a central bank of oil, then I'm sure they will try to be more actively trying to managing. But then also they have to understand the market dynamics, as I highlighted earlier, that the timing of these announcements and how the market responds to it is, and really trying to get the market on their side when they do it, is really important for it to be successful.
Okay, well, there's our survey question today, which is oil prices are telling us that global recession sentiment is now clearly outweighing the demand growth story, with prices being pushed a bit lower yesterday. Agree or disagree? And we'll see the results of that later. Richard, back to you, and let's just talk a little bit about the US position on, let's say, or reaction to OPEC Plus. The last voluntary cuts that were announced a few weeks ago, the US didn't say anything. It was probably briefed and expecting it, and more prices remained more or less okay. They didn't sort of rocket much higher. But with Biden now facing, just declared his re-election stance, we won't comment too much on the politics of that internally. But how much does the oil price story now feature into his sort of inflation war, his sort of war on inflation, if you like, domestically? And geopolitically, has the US lost its voice in its influence?
I think the US has lost its. I think the U.S. has lost its voice in oil pricing. I think we've been pushed to the side. I mean, if you remember, there was going to be they were going to put a put on the price, right? That we were going to start buying oil when it got down to the 60, 62, 63, to kind of fill back up the SPR, and how that was going to be a great trade. And when it got down there, they said, "Oh, let's not do that." The current government is so anti-oil that you really can't. I don't know how they're going to get out of the situation, right? They're not going to change the laws to allow for increased production. So I don't think there's anything that the U.S. is looking at as far as oil policy. I believe now that they're not going to be allowed to pull barrels out of the SPR again. I wouldn't put it past our government to during the next election cycle, if prices are higher, we're going to start to see, let's put more SPR out because there's a problem. It was a political problem all the way, and it worked, right? It was a smart, from a political perspective, they got the prices of gasoline down. Gasoline prices are starting to increase now. I live in California, and I cannot tell you the dysfunction of what we're seeing here. I understand the transition. I understand where people are going, but I've been in the business for many, many decades, and I've been from a refiner to a trader to Wall Street. I've seen many things, and I cannot put together what's happening in this energy transition. In California, they're closing down 2 refineries that have the capacity to produce 210,000 barrels a day of products, which is half gasoline, 30% distillate, asphalt, butanes, all that. And they're going to produce 80,000 barrels of biodiesel created from soybean oil and fats and greases from kitchens. That is illogical at the extreme. I understand it's important for the environment, but if you're building a coal plant in China, it doesn't really matter. So gasoline prices in California are extremely high. They're going to be the highest in the country by far. We're a very populous state, but people don't seem to. They're paying it. So I think there's this tremendous disconnect that's going on. Inflation in the United States is here still. Everything's still very expensive. Food, travel, everything is up. I think oil is just part of the equation. I don't think there's anything we can do about it. I don't think that, and I think OPEC, to me, one of the biggest factors that we see in this market, it's in backwardation. In my experience, markets that are truly weak move into contango, and they move into contango pretty quickly, and the market knows what's going on. In this case, this market remains in backwardation, I think, going out 4 years. I don't think it's not just backwardation in the short term. It's backwardation going out a very long time. And to me, that's a market saying that, well, it might show some weakness in the front end, but let's not get caught up with the market's going to be down at the long term.
Yeah. Thanks, Richard. Noor, Richard just mentioned coal and China. I wanted to go to you with a point on that. That China, in terms of the imports that it's been taking in the first quarter, have been quite good, oil imports. And I don't know what the outlook for that going forward is. People are saying it's going to be pretty steady in terms of what the economic growth story shows, but also it is quite sort of price sensitive, isn't it? So, if we don't see prices weakening anymore, or even going back above 80, which a lot of people are saying will happen in the second half of the year, will that kill demand from China for oil, and will it switch again to coal, take on more Russian crude, etc.? How price sensitive do you think it is?
Yeah, okay. Yeah, China is price sensitive, but I think that at this point, when it comes to the crude, China has got more choices than a lot of other countries, right? Because they are continuing to buy Russian crude as well as other crudes that other countries will not touch. So I think to some extent, China will always give a message. Just to give you an example, when immediately after the latest OPEC plus voluntary cuts, what we saw was that an increase of the official selling prices, the Middle East OSPs, into Asia. And basically the Chinese refiners nominated lower volumes than they did in the last few months. So that, I think, to some extent, was them trying to indicate to all sellers, producers, Middle East producers, that should prices go a little bit too high above their ideal level, they could pull back. But the thing is that I think that in terms of the demand, we also still expect that it should be growing. It shouldn't be crashing in terms of China. So there is a level that it's not as if they're going to cut drastically. But I think the point with China is that as they continue to import Russian crude, and if Russia continues to produce and export, the Russian crude is still the cheapest crude that is in the world right now. And the bottom line for Chinese refiners would still be better if you were to compare with the Singapore refiner in Singapore, refiner in South Korea, refiner in Japan. So, they're not in a dire state at this point, right? Because of the choices that they have and the fact that they're not going to stop importing Russian crude. So yeah.
And regardless of the I mean, Ole, just to go to you for the final thoughts before that, let's just look at that response. Agree as a majority that, you know, clearly outweighing the, okay, so basically the global recession sentiment is today at least outweighing the demand growth story, and if that continues, obviously we could see prices slip a little further. Ole, just to go to you on the final comments for today, in terms of those options that China has and switching to coal, Europe also in terms of its options, if you like, and in terms of how sensitive it's becoming to oil prices, given the economic stresses that it's under, you know, cost of living crisis. I mean, how is that cost of living crisis still very much front and center of people's minds? Inflation concerns, etc. in Europe. Gas prices have gone down a bit. What's the sense and sentiment in Europe going forward as we kind of go towards the end of the year?
Well, it very much depends on whether you live in Stockholm, London, or in Central Europe. Because if you're in Sweden or UK, you are most certainly suffering from very high inflation still. Whereas inflation is starting to come down quite rapidly here in the majority part of Europe. So it's becoming less of a concern. We've been through the wage negotiation across Europe, which have yielded some higher wages, which is to help alleviating some of the stress. Energy prices, as you mentioned, has come down. The gas price right now back below 40 euros. If we are filling up the storage before September, then we could probably drop below 30. So and winter prices are still very well under control. So overall, it's looking up, looking a lot better than it did just a few months ago. But again, we're not out of the woods yet. We need the war to come to an end in Ukraine. We need to see how the coming winter, what kind of level, whether we get another cold winter or do get a return to a cold winter, whether that's going to play its part as well. But for now, at least some of the stress has started to is easing.
Okay, well, Ole Hansen and Noor Ahmad and Richard Lolloye, thanks so much for joining us
Thanks very much.
today on the Energy Markets podcast. War in Ukraine hopefully will come to an end, but I don't hear a lot of people saying that they think it would actually will do this year. So let's live in hope at least. Thanks so much, everyone, for joining us, and have a great day.
Thank you very much. Bye.
Bye.